Well, we're here at the floor, as you can see, of the New York Stock Exchange. Today is Monday, December the 8th. I think the importance of the place speak itself. We're here with Steve Lawrence. As you know, she's the Chief Investment Officer of Balfour Capital Group. We're here with our other friend. They have a family office, Andrew Schreiber, and he's going to talk to us about his firm Sane, but not only that. He's going to talk to us today about the private markets, private credits, the opportunities, the big elephants that are entering into that field, major private equity funds, and what he's seeing is happening in the landscape in a market that, don't get me wrong, it will be extremely affected with change on interest rate here in the US, potentially this week. Andrew, thank you for coming. Steve, Andrew, going with you directly. I think the first question is, where are you seeing opportunities within the private markets? Everybody's talking about that. A lot of investment might happen, great yields, great opportunities. If you can please let us know, that'll be great. And thank you for coming, Andrew.
Pleasure. Thank you for having us on. Steve, do you want to start it off?
Yeah, I mean, listen, one of the things that you're going to see in the private markets is the potential size. It's true diversity. What are private markets? What does that mean to the retail investor? There are many institutions that don't have the ability to get lending with true collateral, but they're, the bigger institutions, the KKRs, the Blackstones, the Apollos, they're doing private market deals, and they're allowing their institutional investors to get much higher yields, anywhere from 9 to 13%. Whereas there's an entire market that is suitable for high net worth individuals and the retail investor to get involved into private markets, private lending, whether it be lending on receivables, hotels, we can go on. And between, Balfour Capital and Schreiber Asset Management and its family office, we see a complete global network to approach the public on, and having the diversification that they need.
What do you think, Andrew? If you can articulate a little bit better, yes.
Yeah, very much so. I think, look, very much. I mean, we've been very much involved in the traditional correlated marketplaces for many, many years. And probably going back to the last 7 or 8 years, which literally does take us back to after 2008. We've been very passionate and seen more and more opportunity where these private marketplaces have been coming to the fore. And we've been dealing with a number of companies, a number of developers who have been looking for private credit because they've found it more and more difficult to get it from the banking institutions, and they've needed this. We've taken this to the private clients, the high net worth individuals, and it gives them access to something which a far more security for their capital and far more transparency, fixed returns, good income, which is what all of these people want. And quite frankly, we're in a position now where we were doing, a few deals a month, and now on a regular basis every week, more and more people have got very excited about the private credit market, and very much so. I mean, a number of people turn around and we say, we wish we'd known about this 10 years ago. It's a market that's growing hugely, and I think also from statistics, the vast majority of this market up to now anyway has been US based and institutional, as Steve said, but very much more now coming far more into the space of the ultra high net worth and high net worth individuals, and some into the retail market. And Europe is growing very, very fast and taking off as well.
It's excellent. And I think one of the things that I want you both to articulate is the risk associated with the asset class. Because obviously, one of the most important part is the underwriting process, making sure that when you invest in those private deals, you have plenty of collaterals. And I think it's great the aspect that is not only now institutional in the US, but that everybody globally is going. And as soon as you have great collaterals, great opportunities to manage the risk, it will be better for the end investors and the high net worth individuals. If you can tell us, Andrew, how are you guys managing that part, which is critical for your investors and for the incoming investors that are going to be investing and co-investing with you? That would be great, please.
Well, number one, predominantly what we focus on, it is direct lending, okay, with the people who are investing. So predominantly it's direct lending. They are that is the senior debt. They have first call on the money. It is underwritten by collateral, by security, sometimes by personal undertakings as well from the people behind the structures. Okay, so it's directly to them. Unlike institutional, collateralization or institutional guarantees, which in actual fact is laid up to the hilt with leveraging as well, which actually distances the investor from the face of the investment. Therefore, being first call, should there be a problem, they are far more secure than anybody else in full transparency.
Yeah, I couldn't. Yeah, I couldn't agree with that more. I mean, the underwriting process, you're really having true diversification, and you're really not correlated to the stock market, believe it or not. All right, many
Totally
times,
uncorrelated.
exactly, you're really not correlated to the stock market because these are private investments, and we've all been able to realize that the bigger institutions, once again, the Apollos, the BlackRocks, they're already in that market at a much, much higher level for bigger deals. And that whole market, it's so much, you can actually get such a cleaner underwriting package when a company's doing EBIT of, 15 to 50 million, 100 million a year. All right, it's just a cleaner package, and you're actually having the ability to deal directly with the institution, and there's no middleman. And you're seeing it in various markets, and it's growing, and it's probably one of the fastest growing markets in the world, if not the fastest, and it's global. It's about yield.
Steve, and that and exactly about yields and about markets. Where do you think the bulk of the opportunities? If you can try to tell us the buckets in terms of what industries you're seeing that are basically offering great collateral, great growth, and an ability to capitalize when these, let's say, small, medium investors, families are looking for deals. You see what happened in media here in the US. I don't know if you can articulate what are the buckets that are happening in Europe or Asia, where you probably guys have a clear vision of what's going on. If you can articulate on that, that would be great for the audience, please.
Litigation financing. Okay, litigation financing is probably one of the largest growth areas in the world. And you've seen litigation financing in the US, and it's really starting to grab a foothold in Europe because it makes sense. Andrew can tell you other verticals within it. And why don't you just describe to him some of the stuff that Saint has going on and the type of product lines that we're offering the public, as well as small to medium-sized family offices.
Yeah, very, very much so. I mean, from a litigation financing point of view, there's one company in particular which we do support and have been doing for the last 7 years, who came to fame, amongst other things, is zero default on the loans, zero default back to with income to investors, zero default on return of capital. And the process is very simple. I mean, litigation is big worldwide now. I mean, Americans were always at the forefront of litigation. Europe now is big in litigation as well. And all of the cases that they fund tend to be class actions, which already have a proven track record. Number one. Secondly, all the loans are very, very small. To individual cases are actually only between £5,000 and £10,000 per case. However, the legal firms obviously take much bigger loans to service what are they doing, because they're class action suits from a number of people. Again, security, there is what we call ATE, after the event insurance. All transactions are insured before any money moves to any lawyer. Okay. If there's a failure in the case, the company still receives their money back, the interest is still paid, okay, and the investors still get the money. But that said, with this particular group that we're dealing with, who now have just over 400 million under management, approximately 300 million of which is lent out on litigation cases, there has been a zero default through the whole chain of events. And another great thing about something like this, there is no leveraging. There's no bank leveraging to try and scale this up. It's all purely investor money. So essentially, it's a cash transaction right the way through, which is fantastic. It works very, very well. Short-term, 12-month minimum investment period, returns paid quarterly or every 6 months to the investors. And anyone and everyone we know who's invested there goes back again and again. And there's people from small retail investors through to some very big institutional investors. In fact, just this last week, we had a couple of big bank institutions who put a lot of money into that fund itself to take it forward. Outside of that, other opportunities, business development, property development companies there's a big need. Property is very straightforward, very good track record. In particular, London itself is probably one of the cities at the forefront of property and property growth in the world. And we deal with a company who specializes in acquiring distressed properties for various reasons, be it bank distress or other distresses. Again, purely on a cash basis with their own funds, investor funds. Leveraging is never more than 60%. Okay, so they always have an LTV of at least 60% to maximum, and good returns, quick turnaround. People are very, very happy. Making quick profits, very, very good solid track record going back over 9 years, just as another example. There's a number of others we can mention as well. We've got people taking advantage of the gold prices, but more so, everybody's buying gold right now. And the prices are going up, and that's fantastic. But that means the gold price is going to come down at some point as well. Okay, so unless you time it, like the equity markets, you may not do as well as you hope. However, these companies, there's two companies I deal with, who both of them have a very, very similar strategy. They utilize investor money to create a pool of money, which is kept in trust, used as a show of funds against fixed contracts with sellers of unrefined doré. Okay, and they also have fixed contracts with refineries and buyers of refined gold. When I say fixed contracts, fixed discount for 5 to 7 years at a time, which means regardless of the movement of the gold price, the margin remains constant. Clients get a fixed return, a very decent return, and at the same time, the capital is secure because it sits in a bank account, in a trust account, as a show of funds, as simple as that. The only money that moves is on the trade side. Very simple, very good, ingenious trading method, quite frankly, taking advantage of the gold rush, but without being exposed to actually physically holding gold, which, although fantastic, we know it's one of the best assets in the world, can go down.
And I think
excellent. Listen, Steve, now they are wrapping up, and you are a common guest here at the Further New York Stock Exchange. Can you explain the audience a little bit about the alliance between Balfour Capital Group and Saint, between Andrew and you, Steve, and what is the best value proposition that you both are basically giving to the end investor, the clients, please?
Okay, well, I'll go first. I mean, obviously, the relationship that Andrew really opened up my eyes, all right, to how large the private credit market is and the type of client base, and what my wealth advisors need globally is A, they're looking for higher yield, B, they're looking for quality product, and C, aligning yourself with two professionals who combined have been in this business over 50 years. It's just a real competitive advantage that the world really doesn't see today. And that is the synergy between Balfour Capital Group and Saint, okay, and Schreiber Asset Management. And I think I really believe, with the utmost amount of conviction that this market is going to be here for the next 30, 40, 50 years. It's a new market, but it's not a new market. It's a market that the public really needs to be involved in. They just never had the opportunity to get involved in it. And now there are vehicles that can do that.
Very much.
Andrew, if you want to
if I can add, sorry.
Yes.
Yeah,
Yes,
I was going to say, if
yes.
I can add something to that as well, which is, I think, very important, is that, I think for a change, the kind of thing, and what I'm very passionate about, and Steve as well, is bringing to investors what they want and what works, instead of feeding them something and trying to convince them that is what they should want. We're bringing people what they want, what they really need, what they're looking for. It's so simple, so transparent, and yeah, the results are there and they're good track records. It's giving people what they want instead of trying to find the best of something they don't quite understand.
Well said.
Simple as that.
Yeah.
Well, excellent. We basically covered this from the floor, as you can see, from the first New York Stock Exchange. A lot of things are happening, Andrew. We're going to bring you back from time to time. Steve is a regular guest with us in all of our distribution outlets. Very happy to have you here. Everybody, very happy to talk about private markets, which is an important topic. And hopefully the end investor will understand better from you both how they can capitalize and profit from that important asset class. Thank you for coming, Steve. Thank you for coming, Andrew. Very happy to have you both here. Thank you.
Look forward to it. Thank you very much. Thanks very much. Take care, Victor.
Take care, Ben.
Take care.
Bye.